All right, let's jump right in. Today, we're digging into a very specific corner of the U.S. tax code. It's a section that some financial pros claim is a huge key to unlocking tax-free retirement income. We're talking about Section 7702.
So let's just start with this question. Really think about it. If you've got an IRA or a 401k, you know the deal, right? The tax man is always waiting for you at the end when you want to take your money out. But what if there was a way around that? A way to get your money without that tax bite?
Okay, so let's get into the weeds a little bit. The whole strategy we're looking at today revolves around this one thing, Section 7702 of the Internal Revenue Code. It's the part of the law that lays out the tax rules for life insurance, and, well, it's the key to this entire idea.
So what this section really does is define what counts as a life insurance contract in the eyes of the IRS. And if it qualifies, the cash value inside it can grow and grow year after year without you paying taxes on it. According to our source, if you structure this thing just right, as a maximum funded tax advantage insurance contract, it can actually work as a pretty powerful alternative to your standard retirement accounts.
Now, this is absolutely crucial to understand. We are not talking about the kind of life insurance your grandpa bought. This isn't about the death benefit. In fact, our source says the goal is the complete opposite. You want to structure it with the least amount of insurance the IRS will let you get away with while stuffing in the most amount of money possible. You're basically turning it from a death benefit tool into what the source calls a cash cow for your retirement.
So how on earth does this thing avoid taxes? Well, in the U.S., pretty much all income gets taxed in one of these three buckets: earned, passive, or portfolio income. But the claim here is that when you access your money from these special policies the smart way, it just doesn't fit into any of those categories. And if there's no category for it, there's no line for it on your tax return. To really get how that works, our source breaks down the three ways you can get your cash out of one of these policies. And they've given them some, let's say, very memorable names: the sad way, the dumb way, and the smart way.
And here they are. The sad way. Well, that one's pretty obvious, right? That's dying. Your money gets a step up and passes to your family income tax-free as a death benefit. But we're more interested in getting the money while you're still around, which brings us to the dumb way and the smart way.
Okay, let's dig into the core of this whole thing, because the entire strategy, every bit of it, comes down to understanding the huge, huge difference between making a withdrawal from your policy and taking a loan against it.
So check this out. It's all right here. If you go the dumb way and just withdraw your money, it's tax-free at first, but that only lasts until you've taken out what you originally put in. The second you touch the gains, boom, you get a tax bill. But if you go the smart way and take a loan against your policy, the IRS doesn't even see that as income. It's totally tax-free, and the best part? Your original money stays in the account still working for you. Now you might be wondering why the dumb way works at all in the beginning. It's because of this key difference. See, most of your other investments, like annuities, are LIFO. That's last in, first out, meaning your taxable gains are the first thing to come out. But these insurance contracts are FIFO, first in, first out. That means you get to take out every penny you put in tax-free before you ever have to touch the gains.
Okay, so that was the dumb way. Let's move on to the smart way, because this is where the strategy gets really fascinating. The argument here is that by using loans, you can actually make money on the exact same dollars that you're borrowing and spending somewhere else.
So just picture this for a second. You've got a big chunk of cash value built up in your policy. And let's say it's having a great year. It's linked to a market index, and it earns a 10% return. Great. That money is just compounding away inside the policy, tax deferred. But now you need some cash, so you take out a loan against that policy. The insurance company says, sure, no problem, and they charge you a fixed interest rate on that loan. Let's call it 5%. So, you see what's happening here? Your money is sitting there earning 10%, while you're only paying 5% to use it. You're creating what's called a positive arbitrage, or a spread. You're literally making a profit on borrowed money. As the source puts it, you effectively become your own banker.
And listen, this isn't just some theory. The source gives this incredible real-world example. A client needed $1 million for a real estate deal. So he borrowed the $1 million from his policy. That loan cost him $50,000 in interest for the year. But his original $1 million, which was still technically in the policy, had a fantastic year and earned a 25% return. That's $250,000. So his net gain was $200,000, totally tax-free on money he was already using for his business. It's wild.
Okay, so let's tie this all together.
What we've really been looking at is a strategy that uses Section 7702 to build up a pile of tax-advantaged cash. The absolute key takeaway, the whole linchpin of the idea, is using policy loans, not withdrawals, to get to your money. That's what avoids the income tax hit and, in some cases, can even let your money keep growing faster than the interest you're paying.
And all of this really leaves us with one final, big picture thought. You know, we're always told the standard path. Put money in your 401k, put it in an IRA, and just plan on paying the taxes later. But what we've seen today raises a really interesting question, doesn't it? Is that standard path the only way? Or are there other, more complex strategies like this one out there that are meant to be explored?